The world's most famous stock investor has more cash right now than ever. What's that mean for the rest of us?
Welcome to another episode of Millstone River Live, a podcast brought to you by Millstone River Wealth Management.
Since we spent some time talking about Warren Buffett today, we thought it might be kind of fun to share some of his wisdom. These pearls are found in a myriad of quotes that he's attributed with. Sometimes he's even attributed to quotes he never said. But throughout the episode, we'll share a few, again, just for fun.
Hey, Matt.
How are you today?
I'm well. A couple weeks ago, right around my birthday, Berkshire Hathaway releases their annual earnings. That's Warren Buffett's company, which I think most would say is probably the most famous, equity investor, stock market investor that's out there. Recently, there's been many headlines over the last 6 months that never before has Berkshire Hathaway had more cash on their balance sheets than right now, well north of $300 billion. I thought maybe today I'd just pick your brain on, what do you think about that, and how does that apply to our investors?
I always like talking about Warren.
I mean, he really is probably the closest thing to a financial rock star, even at, I think, soon to be 94, if he hasn't already achieved that.
If our business had a superhero, it would look like a guy in his 90s who grew up in Nebraska.
Yeah, in fact, actually, they have those stuffed animals that you can purchase now that Berkshire Hathaway owns, and not only Warren's likeness, but also the recently deceased Charlie Munger.
And who wouldn't want that on the front pillow of their couch?
Yeah. Well, Josie and Edie have some of the pineapple ones, not the Warren and Charlie. So anyway, let's get started. I mean, how do you think that Berkshire Hathaway's decisions, how does that relate to kind of the overall value of the market?
So I think value is a highly subjective measure, even though most people would tell you otherwise. Most people would say, no, it's a numeric value that can be given. You use whatever formula you think is most relevant or combination of formulas. But truth be told, I learned as a child when talking with my grandmother, who told me something is worth what someone else is willing to pay for it. Period, end of story. I've never heard a better definition of value than that. Same could be true for any stock that's publicly traded, including all the stocks that Warren Buffett has owned or owns currently. So, he's been made famous for using the word value, as Charlie Munger and all of their disciples have been over decades for talking about value. And they talk about it in terms of they'd rather buy a great company at a good value than any other way to do it. Seems to have worked for them. Price is what you pay. Value is what you get.
So what are some other factors that people will sometimes use as a way of gauging the market value?
I think one of the common ways to assess value is to measure the stock price relative to that company's earnings over some period of time. It could be past or future projected earnings, but you can measure by dividing a company's stock price by its earnings. And you'll hear that called PE ratio, P over E, price to earnings. So it's essentially just a simple division to determine how much it is. Sometimes when people are trying to grasp the concept, I'll use the example of a unit price when you go to the supermarket. If you're going to buy a jar of peanut butter and you're comparing two different brands and the sizes of those jars are not exact, you look at the unit price and that tells you which one costs more or less, let's say per ounce. PE ratio, or price to earnings ratio, is exactly the same as that unit price in the grocery store. It gives you an idea of what that stock price is really telling you about the value of the company. If you're looking at two companies, for example, in the same industry, and you want to know whether one company is more or less valuable than the other, just looking at the stock price singularly tells you nothing, because it depends on how many shares are outstanding and other factors. But taking that ratio is probably one of the most common methods that people agree is a good assessment of value. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
And utilizing PE, where would you say that the market or the S&P 500 is at the moment, maybe compared to where it's been in the past?
So as we record this episode in March of 2025, there's been a lot of discussion of late, although maybe prior to the start of this month, there was more discussion than later in this month due to recent market volatility that has brought prices down on many stocks, particularly the biggest of them in the last few weeks. But there was a lot of talk that the stock market overall, especially in the United States, is expensive relative to some historic norms. So you could say that the S&P 500, the Standard & Poor's index of the 500 largest American public companies, which is, I think, the most utilized index as a barometer for the stock market overall, people would say is expensive at a PE of around 25. And that the companies that are higher than that 25 number are even more so overpriced at the moment. The index's history over the last 30 years kind of shows that it's really not that expensive, relatively speaking, especially if you factor out of that PE ratio for that index the biggest companies among them. You've heard it talked about almost jokingly, but there's some truth to it, the Magnificent Seven or the Mag 7 stocks versus the S&P 493, meaning that those big seven stocks, the Amazon and Microsoft and so on, that those companies excluded from the index, it actually looks pretty healthy. It's not overpriced necessarily. But we can't take certain stocks out. That's not fair. Now, in the last few weeks, that's changed just a little bit because some of those big stocks have been hardest hit in this recent bout of volatility, and we'll see where that leads. But that certainly is to talk about where the average PE ratio is over time as sort of a healthy number to look at. But I think there's more to it. Be fearful when others are greedy, and be greedy when others are fearful.
There's more than one way to value, though, the stock market. Warren Buffett famously has the Buffett indicator, which looks at the overall price of the stock market relative to the GDP of the United States. And there is some evidence that valuation leads to future stock market performance, but that's only one factor, one consideration. Maybe you could, provide me your thoughts on, some of the other things to consider in using PE alone or PE valuation alone as a predictor of future performance.
Yes, I think some people would tell you that a company with a relative to its historic number, relatively lower PE ratio means that there's more upside potential for that stock price. And so people will look at that as an indicator that there's room for that stock price to go up. I think that works as a general rule more often than it doesn't work. And it's more impactful when you look over really long time horizons. So if all you're going to do is look at it in the near term, maybe over the next few months or a few quarters, that's a pretty difficult measure to take. If you look at periods when the stock market is relatively cheap, meaning that PE ratios are lower than their historic averages, and compare them to periods when it's relatively expensive, you might find some surprising results. In particular, market valuations versus returns, you can break it out into three categories: undervalued, fairly valued, and overvalued. And quite frankly, the fairly valued companies tend to do better over time then those both overvalued, as you would expect, but also undervalued, which some people may not expect. Someone is sitting in the shade today because someone planted a tree a long time ago.
And why is that? Is it because there's other factors other than, past earnings that are important in terms of future returns?
Yeah, so, when we look at periods of time when the stock market is considered to be undervalued, meaning that the PE ratio is in the bottom quartile, let's say, of historical averages, the market is positive about 71% of the time, with an average one-year return of about 9%. So we get that information from Standard & Poor's, and the period of time when the stock market is considered overvalued, so the opposite concern from PE ratio to average standpoint, the market is also positive around 71% and grows at about 9% over the subsequent year. And that's because the valuation is just one of many factors that drive the direction for the stock market overall and individual stock prices. So in our view at Millstone River, we would say the direction of company earnings and the direction of interest rates are a lot more important drivers of the shorter duration market performance than valuation alone. That profitability or earnings, as we like to call it, is what you buy. When you buy stock, you are buying their earnings. That's what you want above all else. It's not to say PE ratio or other measures of valuation aren't important. They are, but they're just one consideration. They're not the only, and perhaps not even the most important consideration when looking at a stock and trying to decide, what is that going to do in the future, which is what we're all trying to figure out by reading those tea leaves. If you don't find a way to make money while you sleep, you'll work until you die.
And correct me if I'm wrong, but I believe since 1955, if you look at the 16 calendar years that the S&P 500 has actually experienced a negative return, 15 of those 16 years occurred when companies' earnings declined and the Federal Reserve raised interest rates.
Right, one or the other happened for sure.
So, you don't have a crystal ball. I know that, but if you were to look at, kind of the strength of the economy today, and you would, kind of look, next year out, do you think earnings are going up or down? Where do you think interest rates might go?
So again, as we record this episode, I think the topic that most people are paying attention to, maybe even concerned about, is the threat, retraction, and new threat about tariffs or about international trade between the United States and each of its trading partners. I think that's kind of thrown a monkey wrench into the works of trying to make those types of predictions. But of course, we expect company earnings to increase in the coming year over the duration of 2025. And we think that because, as we've observed, most large companies in the fourth quarter earnings announcements, greater than 80% of them had positive news to report on the earnings front. However, a good number of them, even though their past performance was considered good, maybe softened their outlook for the duration of the year. That tells us a couple of things. But one of the things it tells us is that they're bracing for a choppy scenario that they need to navigate. If they're doing that, in other words, they're making those types of preparations, they are much more likely to be profitable in the coming year, meaning that they'll be less likely to be caught off guard or to underperform what the prior expectations might have suggested. And if that's in fact true, then we should see growth in the earnings announcements in the coming few quarters of 2025. If you add to that the expectation that the Fed will continue its rate cutting cycle maybe later in the year or into 2026, and of course we don't make interest rate predictions either, because I've never met anyone that got that right. But if in fact you follow that belief, which is widely subscribed to, even if the interest rates come at a slower pace, even if they come later than what was previously expected, I think the consensus would tell you that we should see a relatively strong economy, even though some things are a little softer than they might have been a year or so ago. And if we have a relatively strong economy, then we should see growing earnings and growing stock prices. The one thing that could throw a speed bump in front of that is, consumer spending. If people are worried about the security of their job, if they're worried about the value of their 401k accounts, those types of things give people pause, and then they spend less money. And in the United States, when consumers, people like you and me, Adam, when people spend less on virtually anything, that creates a slowdown in the economy. And then that is where we start to see even more market volatility and perhaps lower stock prices. So we watch that as well.
Thank you for sharing that. Maybe I'll circle back to how we started our conversation, which is, Berkshire Hathaway's cash on their balance sheet. So even with north of $300 billion in cash, Berkshire Hathaway has over $1 trillion market cap. So you could say between the companies they own, like, railroad, insurance, and other types of operating companies, and then their stock portfolio, Warren Buffett at, around 94, still has about 65-70% of his net worth in the equity market, which is traditionally much higher than, what I would say our 94-year-old clients have. So, what should investors do with all this? I think one of the themes you should get from this conversation is timing the market is very difficult. The future is hard to predict. Concepts like value, which makes sense in other parts of our life, do not always translate to successful investing. The good news is that none of us have to be Warren Buffett to generate wealth. Staying disciplined in a long-term investment plan is generally the best path to successful wealth creation. Do you agree with that?
Couldn't have said it better. Thanks for the conversation. Hopefully people find that helpful, and we'll talk with you on the next episode of Millstone River Live.
We hope you've enjoyed this episode of Millstone River Live. Feel free to share it with someone you think might benefit. Millstone River Wealth Management is an independent wealth management firm based in New Jersey. We form a supportive partnership with our clients and help with financial education and planning. We welcome your feedback. Send comments or questions to podcast@millstone-river.com. More information about our firm can be found online at millstone-river.com. Thanks for listening.